Good evening, ladies and gentlemen. This is Clueless 8, and this is the weekend update or the weekend report for the week ending on Friday, November 20th, 2015. Okay, let's kick off. We had a very, very powerful and profitable week on many fronts. Selective positions that were bought at the lows of Friday, the 13th, 2015, and also the tactical lows printed early in the day on the following Monday. That was November 16, 2015. Every single position, individual stocks, as well as the indices, S&P 500, Russell 2000, trades delivered an average rate of return or return on investment ROI in excess of 60, 100%, and some as high as 400%. I will be doing a series of options charts that will show clearly the calls made on Apple, the lottos, which exploded more than 2,000% by Friday. Just staggering numbers. Keep in mind that the Clueless 8 trading service, the work is very specialized. I do a significant amount of predictive game theory analysis based on my experience, based on market technical, based on the background, the macro fundamental economic background of what's going on, a good dose of behavioral sentiment, and conviction, and of course, an element of luck. Mixed in together, we have a potent combination of profits and successful trades. Please refer to my videocast, which I will reprint the link on this on this end of the week report to remind yourself what I said on Monday at the lows, when the despair and the sentiment, even in our chat rooms, were at a low, and what happened by the end of Friday, just a few days later. So bottom line is, it's not that every dip is a buying opportunity, but I will tell you the tactical dips where I fully highlighted in the strongest manner that these type of deep oversold conditions, similar to what we saw on August 24th, right here, similar to what we saw on September 29th, and what we saw on the lows on Monday of November 16th, were exactly the same, and that is exactly what we call in the business positive divergence. I explain all this thoroughly in tonight's excellent group coaching session. I thank all the members who joined, and I know that you know that it has helped you guys tremendously, especially the members who have taken successive ongoing coaching sessions to develop their skills in navigating this extremely volatile and, in many cases, for the ignorant traders out there, a very random market. There is nothing random about this market. This market is a pure tactical structured volatility, and that's what they do. That's what the machines do. The machines are not random. There are times, keep in mind, specifically when we had the black swan attack, as I like to call it, and we dropped a couple of thousand points in 2 days. Those are not structured volatility. Those are actual black swan unquantifiable events which cause massive flash crashes, and in this particular case, the Dow had plummeted close to 1,000, if not minus 1200 points that particular day on August 24th, which itself created a powerful short-term buying opportunity, driving the markets higher, massive intense volatility. We navigated that reasonably successfully, I should say. Then another drop back on the end of September to get pretty much any living soul who wants to trade the market out of the picture, and then see you later. Then another powerful crash over a couple of days last week, calling in the bears, the grizzlies, the death cross callers, you name it. People in our room who are in effect closet grizzlies and bears. There's nothing wrong with that. I'd rather be a tactical bear than being a dogmatic bear, and I certainly have proven that through my skills in shorting the market on a short-term basis and an intraday basis. But right when they gave up, right here, never bought the lows of Friday, never bought the lows of Monday, the market goes higher. At this point, let me lead in to a very simple statement. It is not the precise, tactical, timely trades and entry points that I provide for the benefit of my members and free trial subscribers. It is you who carries the burden of the psychological weight of acting or not acting, executing or not executing on that call. Majority do not execute. They look for a warm, fuzzy moment when they think everything is okay. Well, by that time that warm, fuzzy moment comes, guess what? The market's overbought, right? The market gets overbought. Like here was the ultimate buying experience. Talked about it, mentioned to people, told them what to do. But by the time they started getting excited out here, the market got majorly overbought. I warned people repeatedly in my chat room posts, in my Twitter posts, to put hedges out there, to take out their large profits on their longs that they have bought maybe at not necessarily at the lows, but around these levels. Many of them listened, some didn't. And when they didn't, they got blown out of the water as we dropped a good couple of hundred points fast and furious. We had some casualties in the trading club, and hopefully they'll return and have learned their lesson. Bottom line is, in this type of volatile environment, the simplest way is you got to buy the technical dip and you got to buy and sell the technical highs. This is a machine-driven market. 90%, I would say, of the trading is automated, algorithmic, high-frequency trading programs. My job is to try to stay one step ahead of them, and I do my best. And I would say majority of the cases are very successful in even the timing of when I put it and when we are getting out. Remember, the biggest trades and the biggest profits are made within the first 24 to 48 hours. And even after that, even after a little pullback, there are moves higher. However, keep in mind that we are getting quite overbought at this level as we get closer to that 2100 or 18,000 on the Dow. So don't get too giddy with your long positions at these levels, because I believe we're in for a quick pullback that's going to bring us down towards the 17,500 level. You're talking about maybe a 200-point type of pullback before we resume our move up and attack the 18,300 level. But in order for that to happen, we need the mandatory pullback, which could bring us as low as 17,400, which would intersect with the 34-day moving average. And worst case scenario, we come down to 17,100, where at that point, many traders, investors, the media, people in other forums, stock twits and all that included, are all going to be dismal. The death cross callers are going to be crawling out of their little cubby holes to talk about the end of the market. But all it would market simply do is test the 50-day moving rising 50-day moving average, probably around these levels, and then possibly bounce. We have a lot of money on the sidelines still waiting to enter the market, and regardless of what our feelings are and our emotion, the fact remains that the market still wants to go higher. Saying all that, anything can change. My job, my responsibility, if you can call that, is to basically look at these things on a very unbiased way and to notify people as quickly as possible. So here are the technicals, and it's very easy to see. A pullback to 17,648, which would be roughly 150 points, would be welcome. I think that would be great. That would basically touch the 5-day moving average on the Dow Jones. And again, it's a powerful week, Thanksgiving week. Generally speaking, you don't want to mess around putting in some heavy duty shorts. So any tactical buys of these levels would be a welcome long position entries. 17,473, if not 17,643. Let's take a quick look at the S&P 500. I've shown this chart several times. We do have a negative divergence, if I'm seeing this correctly, and that is right here. People who take the time to understand these things know very well what I'm talking about. This is obviously a consolidation channel, in other words, a profit-taking channel. However, a profit-taking channel can also break down, and if it does break down below the 2077 level, 2075 level, we are entering back into this channel. If we do enter back in this channel, there are many levels of support. One is a 50-day moving average at 2060. You got the green line here, which is acceleration band at 2064. Then you got 2068, whole bands of support. Okay, that's only if we fall out of this consolidation channel. Otherwise, this consolidation channel should pull back maybe 50 or 60 points. At that point, it should come down to about 2077, let's say, and then make another move higher. Or it breaks down, tests the upper end of this broken downtrend channel, this blue line, and then move from here, or move down here, test the 34 and the 50, and move from here. Those would be the bullish scenarios. The bearish scenario would be break to 2060. At that point, all hell breaks loose. We basically come straight down to 2044. You're talking another 150 points or so. And at that point, this comes into play, the 2030 level. Okay, it's all structured volatility. It's all calculated by the machines, and it's all meant to get you and everyone else out there to stay out of the game because you guys didn't spend the time or the energy to understand how these markets work. It's really as simple as that. In the meantime, we do have somewhat of a negative divergence in the form of the stochastics, which are sliding down as the market basically is consolidating. If we start to go below, the reset will basically bring us down to the same levels that I just spoke to you about. In order for the market to really crack, these levels have to be over an extended period of days, maybe 2 or 3 days, stay at serious oversold levels. And at that point, the markets, when they bounce, let's say they bounce from 2044, which will be a brilliant entry point. You're talking about roughly 50 points, 55 points. You're talking 400 to 450 points on the downside. Again, the media and the typical traders are going to be screaming, it's over. In the meantime, this should be a great short opportunity for us in the form of the index puts, SPX, RUT, even QQQ puts. And the bottom line is the UVXY is always there. And so there's a lot of different fantastic instruments you can use. So that possibility is still there. If we do get down to 2044, we have to stay oversold for a period of 24 to 48 hours. That's it. All right, let's move on. Let's take a quick look at the Russell 2000. This is a powerful formation. I like it. Let me move this line out of the picture. I just drew this to show the angle of what it's doing. But looking at this here, actually, let me move this out. This is a dragon bullish formation. I like it. I think oil will bounce. I've shown enough reasons why. And the bottom line is oil's not just the only factor. So here, I would go from here to up here. That W formation is what brings it up to 1204. If not, it overshoot to 1232. That's a pretty significant trade. Okay, so the RUT has to be concentrated on, and as well as the IWM, which is also shaping up to be. Let me look at the hourly, which again is also not too bad. In the meantime, I'll be watching it very carefully for any technical breakdowns, but so far, not much to be seen. Thank you for listening. I'll keep it short and sweet. Listen to the video from Monday. Remind yourself where we came from and what I said. Thank you again. Good night.